Deposit or investment. Money has a peculiarity: it can't just lie around. Because of inflation, its value will constantly decrease. Therefore, the best option is to put money to work. You can do this in different ways. From a banal bank deposit to trading on the cryptocurrency market. Let's deal with each option in turn. Bank deposit. Bank deposit is one of the simplest forms of investment. All you need to do is deposit your finances with a bank. The tenure and yield of the deposit depends on the terms and conditions offered by the bank. Nowadays it is easy to make a deposit. Often it can be done without even getting up from the couch. It is enough to open the mobile application of the bank and perform all operations there. Apart from simplicity, bank deposits are also safe and liquid. Banks very rarely go bankrupt. Therefore, the deposit is safe. In addition, banks often offer conditions under which it is possible to withdraw part of the deposit without sanctions. Therefore, if necessary, the owner of the deposit can quickly return part of the funds. However, bank deposits have disadvantages. To them can be attributed yield. Limitations of banks. First, yield. Compared to other investment opportunities, returns from bank deposits are often low. Interest rates are typically lower than other financial markets, so potential returns are limited. Second, the limitations of banks. Bank deposits often have limits on the amount deposited and the length of time the deposit can be held. In addition, withdrawing a deposit early may result in penalties or loss of interest. This limits the deposit holder's options. Third, when opening a deposit, the owner chooses the currency, bank, and interest rate. If you want to have deposits in several currencies, you will have to open a deposit for each currency. As a result, you may end up with a situation when you need to keep deposits in different banks with different conditions. This removes one of the main advantages of this form of investment: convenience. Trading on Forex. Bank deposit is not suitable for multiplying funds. Therefore, it is worth paying attention to other opportunities. For example, trading on the Forex market. The Forex market works around the clock, allowing traders from different countries to trade at a convenient time. The market consists of various participants such as banks, investment funds, corporations, and private traders. The Forex market is one of the largest and most liquid markets in the world. Its advantages include high profitability potential. Correct forecasts and successful trades can lead to significant profits, especially when using leverage. High liquidity. You can quickly buy or sell currencies at current market prices without significantly affecting those prices. Global access. The Forex works around the clock and offers a wide range of currency pairs. There are two disadvantages to this investment option. The first is the threshold of entry. To start trading on Forex, you need to make efforts, understand the tools and the situation on the market. There are no universal strategies or win-win options. The second disadvantage. The market depends on macroeconomic factors. Because of this, market forecasting is difficult and unpredictable. Trading on the Forex market requires risk management and a balanced approach. Buying a share in a business. Investing in a share of a business can provide an opportunity for significant capital growth. If the business grows successfully, the share may increase in value. This will result in higher investment returns. Also, this option is relatively flexible. One can buy stakes in several businesses, diversifying their investments. Depending on the size of the stake, the owner may also give the right to participate in strategic decisions and influence the development of the company. The owner of the stake can take an active part in the management of the business or delegate this to other professionals. However, like other options, this has its disadvantages. Limited liquidity. The need for active participation. Risk of losing the investment. Buying a stake in a business carries the risk of losing the investment. The business may face financial difficulties or bad decisions, which can result in losses for investors. Also, buying a stake in a business is usually a long-term investment. Selling a stake can be complicated and costly, especially if there is no willing buyer, which limits the liquidity of the investment. In addition, the right to participate in decision-making carries with it the need to devote time or delegate such decisions to specialists. This places an additional burden on the investor. Pension and investment funds. An investment fund is a financial organization that collects money from investors and invests it in various assets. For example, stocks, bonds, real estate, and other financial instruments. The purpose of an investment fund is to generate investment returns and distribute them to its participants according to their share in the fund. Participants in an investment fund contribute money to the fund. They buy its shares or stocks. The fund allows investors to access a wide range of investments. Many of these may not be available to investors individually. Professional fund managers analyze the markets, select assets and manage the portfolio to achieve high returns. Professional management is one of the main advantages of funds. Also, in most cases, pension and investment funds provide high liquidity. Participants can sell their investments and access the money in a relatively short period of time. The disadvantages of investment funds include potential fees and expenses. Funds may charge various fees such as management, administrative and sales charges. Limited control. Investing in a fund means handing over investment management to a third party. Volatility and market risks. Like any investment in the financial markets, pension and investment funds are subject to volatility and market risks. What is better in the end? A deposit or an investment? Everyone determines the answer to this question for themselves. Deposits have almost zero returns, but they are very simple. Investments are more complicated and risky, but the potential yield is higher.